Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This week's episode features my conversation with David Brand, the SVP of Lending Operations at Sharonview Federal Credit Union. David and I dive into his thoughts around the ability to automate and or outsource parts of your operation or entire products, including the role that AI can play and how that's achieved. Specifically, we dove into their decision to exit the credit card business and outsource that portfolio to another player and how they're still leveraging that partnership to meet their customers' needs. And finally, he really dove into the continued need for not only human interaction, but also their demand for in-person interaction for certain instances, even during COVID, and how you kind of need to balance that with digital interaction. It's a really fascinating discussion with, I think, a lot of interesting tidbits for anybody. So please enjoy my conversation with David Brand. Welcome to the podcast, David. Thanks for making the time to join us.
Thank you, Jeff, for having me.
Yeah, so I've started asking all my guests the same opening question, which I think is really interesting, which is kind of, not many of us grew up dreaming of being a banker when we were kids. What was your route to the position you're in now? Like, how did you get into the industry and into this role?
It's a great question. And right at the start, I have to tell you, what I'm doing is not really that disconnected from a passion that I had very early on, which was what was the future going to look like? I was one of those kids in kindergarten, sat there drawing pictures of what I thought the future would look like, flying cars and whatever you saw in the Jetsons, right? What's that?
You should publish those pictures as NFTs now. You can make some money on them.
If I had them, that would be great. But, I kind of grew up watching the Jetsons. And if anybody's familiar with that show, the video chat, of course, that's come to life. But, so I was just fascinated by what the future is going to look like. So I find in this role, not only is that still my passion, but it's really a necessity to make sure I'm headed in the right direction, right? It's like, what is the future of lending going to look like? What is lending going to look like 5, 6, 7 years from now? And what actions am I going to take today, to get there and be a player in that space?
Mm. Well, jumping off of that concept, I mean, a lot of people I talk about the experience of the last 2 years in COVID and the shutting down of branches kind of accelerating the shift to the future. I'm curious what you see that future looking like, and if any of the things you experienced during COVID have changed your perspective or kind of redirected your thinking about what you think the future of this space really does look like.
Yeah, it's a mixed bag. I mean, certainly we've seen a rise in mobile transactions, both on the deposit and lending side. No doubt some people did that out of necessity. And then once they did it, they figured, hey, this isn't so bad, and this is probably a lot easier than having to drive into the branch and give my credit union a check drawn on the credit union to pay a vehicle loan I have with the credit union. And when I see people doing that, I'm like, don't really understand it, but I realize there's probably a deep-seated need for a lot of folks to have that human connection, and probably always will be. But I think as we continue to evolve through this, I think we're going to continue to see shifts to doing the simple things online, applying for personal loans, even auto loans, paying loans, making balance transfers and so forth, doing that online, but still wanting the personal touch for the more complex transactions. If I'm going to make an investment, right? I have $100,000, I need to put that somewhere. I'm going to buy an investment property or a primary residence. I need a mortgage. Those are things that probably, there's still a space for brick and mortar for people to have that human touch. But we've got to show them, educate them, and train them on the self-service aspect of the transactions.
Do you found that kind of education accelerated during COVID? I did find that the people who never would have thought about mobile deposit, like they did it and they went, oh, like I kind of forced education, if you will. Maybe that sounds wrong. It's got a lot of bad history around forced education, but people were kind of pushed in a direction, but then I think are adopting it naturally from that point.
Yeah, I think so. It's a twofold effort, hand-to-hand combat type situation where you've got somebody coming in with a transaction that they can do on their own, and just telling them, hey, do you have a few minutes for just me to show you a different way to do this? Mm-hmm. Most people are going to be agreeable to that, and you're not going to win over 100% of the people, but if you can win over a majority of them, that you're definitely successful.
And do you still see the demand? You were telling me you saw, even during COVID, demand for in-person transactions that was a bit surprising to you.
It was a little surprising, yeah. Branches that we had closed the lobbies on We allowed people to walk up to drive-up windows, or we created windows. They were not necessarily drive-up windows, but like a lobby walk-up type situation. And in some cases, we had lines around the block, and I'm like, why do all these people want to stand so close to each other? We have a pandemic going on. But, so I don't, like I said, I don't think you can get everybody to adopt, and then as a business, you have to make a decision, well, okay, if I've got 80% of the folks opted in to self-service, do I still have a business model for the other 20%, or do I just go forward and serve the majority? And we're kind of in that place right now. A quick example I'm going to give of that. I was in New York recently, a place I used to live, and all their toll highways and toll bridges went to cashless tolling. So where you used to go up and pay cash to somebody, that's all gone. It's all eliminated. They didn't ask anyone if they were okay with that, and there's no workaround solutions. There's nobody standing on the side of the road taking your cash before you can get on the bridge. There's no choice. So I think one of the things we're going to have to make decisions about as a financial industry is we're going to go forward, with the new technology, and I think some folks will get left behind.
Interesting. Yeah, that's a hard decision to make about how and when, and probably varies a little bit product to product, like when you're going to say, hey, this is not going to be a thing we do in person. But that is an interesting transition point, kind of an inflection for the industry as a whole.
Yeah, and I think that we're kind of very close to that tipping point now. And there will be some institutions that'll be their niche and say, hey, we're gonna be the ones that are gonna hold your hand through the process, and that's okay.
One of the things I wanted to ask about is, I think we've seen the application of technology, and so often there's a focus, I feel, on the consumer experience in terms of the UX, be it a mobile app or a web app, or kind of like the front end experience. But I feel like there's a lot of opportunity in actually the application of technology and automation capabilities to the back end part, right? That's not the web form to input your information is one thing, but
right.
What happens next and the kind of people process and the manual process that kind of came after is maybe the less sexy part. It doesn't, it doesn't demo well. You can't go to whatever the conference is and put it up on screen. Look how awesome this is. But in some ways it's more important. And I know that's something you guys have focused on, kind of how do we take the back office parts of the business and apply technology and automation kind of as intentionally there as we might on the consumer facing interfaces.
Yeah, I think we have a little ways to go there. But, for example, when you're reviewing income information, right, there's a lot of, some of the fintechs have built some great tools around that, connecting with Plaid, for example, right, to do income verification. But, we, in some areas of our business still, we're asking them to provide us with pay stubs and tax returns, and we have somebody actually reviewing them and hand calculating that income, and that's something we're definitely going to move away from sooner than later. And also the decision factor, right? Having somebody sitting there reviewing all the facts and making a decision, that can be done, with artificial intelligence. There are proven systems out there for that can pull in alternative data and different decision points and make that decision automatically. We work with a company that handles all of our non-prime auto decisions, and they service an entire country full of financial institutions with no human underwriters. So it can be done.
Yeah, the idea of no underwriters, I think, is so mind-blowing to many financial institutions that you would hand that off to a machine. Did you have concerns about moving to a world where you're in a fully automated, decisioning capability? Whether it's interesting because I think there's a question of like, how do I get comfortable with AI? But you don't have to be using AI or anything fancy to take the scorecard you used to have and turn it into an automated process that can pull a credit record and deliver an answer based on the information provided. Do you have concerns about the move to automation? And then after that, we'll maybe get into the concept of AI and how you feel about that.
Yeah, the one thing is you can't set it and forget it, right? So I think you still need folks that are going to be able to review and interpret that data, make sure it's providing us the intelligence to inform and to make the right business decisions. So I think there's probably a shift behind actual people doing that manual underwriting work to having people that are reviewing and validating that data and ensuring that it's trued up with what we expect.
That probably is on two levels too, right? The reviewing of the data for the process, but then the kind of what I think of as the program or the portfolio management is still like is this thing doing what we thought it would do? Do we need to configure the rules differently? Do we want to price things differently or change a tolerance or something like that that you're probably looking at on a pretty frequent basis, I would imagine.
Yeah, I mean, for example, we have a monthly credit review committee that meets, looks at the portfolio. We look at trends, we make decisions about pricing and underwriting and so forth based on that. But so I think the shift then becomes more to focusing on getting this data, reviewing this data, and making good decisions around it.
I'm curious, as you talk about that, was there any investments you needed to make in kind of the ability to have that data readily accessible? I feel like so many of the things in this digital world rely on this infrastructure of, well, we can do that with data analytics. And I go, well, how easy is it to get the data? And do you have the team and the tool sets to do the analytics? And that's, a part that it's not always easy to go from, I know the information is somewhere, to I have it in a way that I can digest and utilize in a rapid basis.
Yeah, we have a truly robust and brilliant business intelligence team comprised of data analysts, data scientists, and so forth. And we work heavily with Power BI dashboards, for example, and we're constantly refining that process, adding new dashboards to give us new visibility into new data points and additional data points. So it's really remarkable. I've worked at a lot of institutions, some quite larger than I work in now, and I've never worked with the amount of intel that I'm able to access at my fingertips on a daily basis.
Wow, that's fascinating. I mean, do you have advice for other institutions? I feel like building that capability, and it's fascinating that you say it's better here than at some larger institutions. What's your advice on how you make that true in an institution that's maybe not there, that's saying, hey, I'd like to have that kind of access to information, that access to even intelligence, right? One level above information. It's like actually turning lots of points of data into some knowledge or useful information. Are you have any advice on how you get to the point where that's, you feel like that's well executed in the institution?
Yeah, I mean, if you're not able to build that team internally, there's certainly great companies out there that provide the ability to warehouse your data and then view that data. Encino is one of them. I've worked with them for a number of years. They're still a current partner of Sharonview, but there's certainly plenty of options that way.
To me, it's like one of those underappreciated areas of investment for an institution, and it warms my heart to hear that you feel like you've got a world-class execution there, because I think that's going to be pretty critical to the future.
I think a lot of organizations do track data, but they're doing it in Excel spreadsheets, right? So it's really not efficient, very time consuming, and subject to error as well.
The other part of that I often find, and I'm curious if you guys have been able to do this effectively, is being able to not only have the data, but to bring data from different systems together, so I can look at things like maybe portfolio performance by marketing channel or profitability by marketing channel, where I got my profitability over here, my credit performance over there, my marketing analytics over there, and never the twain shall meet. And then when I want to ask the question of like, is this channel producing profitable loans or not? It's actually quite hard, because I need to bring those systems together. And I feel like that's the other part of data it's not just one set of data that I can import to Power BI and pivot. It's like, I've got to bring multiple sources of data together into a holistic view of that business.
Yeah, and that's certainly true for us. With vehicle lending, for example, we both have what's called an indirect channel where we source loans from vehicle dealers, and then we also have our internal branch channel as well, and an online channel, right? So we are able to synthesize all of that data and provide meaningful analysis, right, on auto loan performance holistically. And this helps us with establishing pricing and underwriting guidelines. Also, too, one of the things we're looking at right now is customer or member, as we call them, profitability, right? So we can pull in different data points regarding how they transact with us on the banking side, and then also on the lending side. So yeah, you've got to be able to pull in many different data sources to create that true picture.
You mentioned indirect vehicle financing, and I'm fascinated to hear that. I'd love for you to walk me through a little bit about how you guys think about that business. When I talk to a lot of institutions, they seem to be exiting that business more than I hear about them getting into or investing in that business. So tell me a little bit about how you manage that part of the business and why you're still investing in that area.
Yeah, I mean there are risks inherent in that business, especially fraud, right? Because you're not getting the ability to firsthand via your data systems or people to validate the identity of that individual. So you're relying on this third party then to validate identity. We also utilize resources from our providers like TransUnion, Experian. We have tools that can also help us. Put up a red flag when there's something questionable regarding the identity validation. Um, but it is definitely, like I said, more risky than working with that customer directly. Uh, Also, too, it's highly competitive, so you don't have really strong
Hmm.
margins there, uh, especially when you're competing against banks and credit unions. Are very hungry for loans. They're gonna put out rates that are very, very low. So I think, for some credit unions and banks, they've said, we'll just give a competitive rate and work with the customer directly or go after other lines of business that may be more profitable. But for us, it has represented a significant area of loan growth over the last 2 years. Um, we saw last year a 50% increase in production
Wow.
over 2020. Um, and even with it's been the supply of autos
Yep.
has been very challenged, of course. A lot of press, around chip shortages and so forth, leading to shortages in inventory. But um, we've been able to expand out over a couple different states and really, diversify our portfolio that way. The other big thing about that too is that we are able to go into markets where we don't have a physical branch and don't have that footprint, and be able to
Interesting.
start
Yeah.
building member bases, you or customer
So
bases in
indirect
those
auto has
new
been like a
markets.
geographical expansion approach for you in terms of markets you haven't had a physical presence in before. That's a really
Right, and it helps us in a way too, because if we ever said, hey, should we put a branch in this market, we can look, okay, well, what's the new member growth been like, and what are we seeing from those members that we've acquired through the indirect relationship? So it gives us an early indicator of the
that's
strength of
really
the
interesting.
market.
I'm curious how much you've had success in. You said the branch-based automobile financing and the yeah, and the digital because most of the institutions I said I talked to are exiting or thinking about exiting indirect because of the low margins and the high competition, and I would say are excited about the opportunity to grow their direct and digital and branch channels, but struggling with the execution of that. I'm curious if you've seen things that are particularly effective in helping you grow that portfolio because I think it's you often the loan is like secondary in the consumer's mind to the purchase. And so they go to the dealer before they go to the financing, and the dealer's
Yep.
got a good chance, even if they went to you, they're like, well, I can get you a better deal from my guy down at the local whatever that the dealer has a relationship with. So I'm curious if you have any tips of how you've seen, the execution in that direct auto space, be it digital or in branch, be successful.
Yeah, one of the things we're looking at, I know other organizations have found success in, is working with auto brokers, right? So there's a variety of companies out there create their own marketing funnel,
Mm,
source their own leads, and then will pass leads along to credit unions and banks based on
mm.
the credit or eligibility boxes that they've established. So we are looking at that as a way to add value to the existing business model that we have. We also do what are called
Mm-hmm.
propensity or pre-approval campaigns. So, we go out monthly and we're targeting about 20,000. These are existing members, to either recapture a loan, that they may have done elsewhere, or to, if they're in market, right, make sure that we're there and capturing that loan. So, there's that opportunity with the existing base, and then the opportunity with the auto brokers to go
Yeah, yeah.
after customers we don't have today, and
Do you do any
win
refinancing?
that
Do you actually
relationship.
pursue people that you see like a loan that they got through some other provider, maybe indirect at a dealer or something else, where you find it and go, hey, we can go win that business back. We deserve it, particularly for an existing member. You want to go and like you want to earn back that loan and get that balance back on the bank on the credit union balance sheet.
Yeah, no, absolutely. That's part of our campaigns that we run, and part of the training also for our staff, is when they're having that consultative conversation with somebody, is taking a look at that credit report. And even within our system, they've got the ability to calculate payment
Oh,
savings
interesting.
and tell them what they'll save
Yeah,
by
if you could
switching
do
that
that
loan over to
in
us.
real time, that's pretty impressive, and I think powerful. I mean, most consumers I know like to save money, so if you can actually reduce a monthly payment, they're open to it. Now, I know you talked about
Definitely.
parts of your business where you're outsourcing some number of functions, and I think particularly an interesting strategy for smaller institutions, be they credit unions or community banks, that don't have the same kind of budget to build everything out in-house for all the lines of business they might want to go into. I'd love to get your thoughts on how you think about things you're interested in, maybe partnering with somebody or outsourcing to an outside firm, and what you think is really core for the institution to own internally.
Yeah, so big change for us about 18 months ago. We sold our credit card portfolio to Elan Financial Services, and starting about a year ago, they began to issue on our behalf as well. So it's a white label program. The credit card says Sharonview,
Yep.
but we're not issuing it. We're not servicing it. So it's been a great partnership because they were able to help us step up with many new cards that we wouldn't have been able to bring to market for years, probably, if we tried to do it ourselves. For example, we just launched business credit cards last month, four
Wow.
business credit cards with them, and it was turnkey. So, having the ability to do that, they have much better controls around fraud. So I think they're offering better protections for our cardholders as well. But basically, this is an organization, this is all they do, right? And they're servicing over 1,000 institutions. That's their area of expertise. They have the economies of scale behind it. They have the muscle, the marketing muscle, and so forth. So we said, well, we'll let them do that on our behalf. And it's actually worked out quite well. And we also receive a share of the revenue and income from the card program, as well as, you know, top of wallet, right? Having a credit card with their name on it. Similarly, we're working right now with Upstart with personal loans. And we're going to soon launch a program where we'll both purchase loans that Upstart has originated, as well as use a Sharonview branded website, but powered by Upstart, to source personal loans directly. And these will also be serviced by this fintech, by Upstart. But it gives us an ability to gain an efficiency on what has been a very clunky process. I'll just give you a quick rundown. Somebody applies to us for a personal loan. They don't know how much they're going to be able to qualify for until we have a hard credit pull, until we get their income information. Then an underwriter is reviewing in a lot of cases manually. And then in a lot of cases, we're telling, well, we can't give you what you asked for, but we'll give you this. And they may not accept that offer, or then come back and counter the counter offer. And, we might have 3 or 4 touches before we land on a number. The beauty of this new, of the product with Upstart is there's going to be a soft credit pull, and Upstart's basically going to say, this is the max you qualify for.
Yep.
You decide how much you want to borrow, and whether you want 3 or 5 years, here's your rate. And if you're ready, hit go, and then we'll make it a full application. And then we have a lot less friction in the process. So again, this is a great example, of a fintech being able to do something better and more efficiently, and will help us serve
I
more
love
of our customers
more efficiently. I think
effectively.
now more than ever, as consumers are, particularly when they're in the self-serve mode, looking for the most efficient, frictionless, seamless, fastest process they can. I mean, we're all, I guess, spoiled by Uber and Amazon. Like when something's not Amazon Prime and I have to wait more than 2 days for it, I get upset. And that's a pretty different expectation. But I think it's creeping into all of our areas of life where we expect that kind of immediacy of response. And it,
I give up if a
oh
site
God,
takes
30
more than
seconds.
30
Yeah,
seconds to load.
there was an
So,
SVP at Google when I was there named Jeff Huber. I don't know that he quoted this, but I always think of it as his quote. As he said, "Speed is my favorite feature." And so, it's just like, what's your favorite feature? Gmail says, "Speed is my favorite feature. Loading fast is my absolute favorite thing." And you could really see the difference, even in the case of Google's apps, in milliseconds. When you would shave a couple milliseconds off of load time, the happiness, the interactivity, the utilization would increase. And that's, 30 seconds, I can't admit 30 seconds is bad. That's too
absolutely.
long. But people are really sensitive to that kind of time and waiting.
Yeah.
So one other thing I wanted to touch on with you is, as you outsource things like your credit card or, the kind of processing of personal loans, what are the things you still think of as the core things you as a credit union are executing, kind of owning and using to differentiate you versus other financial services players in the market that your consumers could work with? Like, what is that core that you're still saying, this is where we're investing in really differentiating ourselves?
It's really the experience. how easy it is to transact, how fast you can transact, and the education piece too. Are we providing you useful information that's going to help you make an informed decision? Um,
Mhm.
I still think we have to add value. We can't just be about transactions, but we have to be a
As we've talked
resource
about
for the
kind of
consumer as
automation
well.
and self-serve, where do you see the role of, non-automated interactions in that kind of information, education, advice? Like, how do you actually optimize for that consumer experience and give them, what they want when they want to, be that automated or be that human? And where do you think that line is?
Certainly, with the more complex transactions, as we were talking about earlier, you're going to invest funds or buy a home. You're going to start a bit. You're going to need a loan for your business. I think those are the types of transactions that, while you can automate all of those
Mhm.
things, I think there's still going to be a preference for that personal contact, some interaction, some advice during the process, so we become like a trusted advisor during that process. And some of it's a hybrid. We're going to have a little bit of switch when we go live with Upstart in a few months, where our staff is not going
Mhm.
to be entering that application on behalf of the customer or consumer like they are today. So they're going to have to educate them on, well, maybe in the past we might have done it this way, but here's a new process, and they will have an iPad in the branch, and they're going to hand them an iPad, and they're going to be there and answer some
Mm.
questions, but we're going to train the consumer, how to enter their information on that iPad, or their phone, if they have it and are comfortable with that. So it's kind of like we're going to kind of assist you and bridge you to the next level.
That's really interesting. Uh, I like that approach, and it's really my sense. I'm curious if you, that is where community institutions, be they credit unions or community banks, have this kind of advantage: the trust, the brand equity, and the ability to kind of serve in a personalized way that I think can get lost in the larger institutions. Feels like the place to invest and really execute well if you want to differentiate in the future. Certainly, we've always been at the forefront at Upstart of the kind of shift to unsecured lending, which was pretty minimal for most institutions. Credit unions less so than banks, historically, and is growing rapidly. Are there other changes in product mix that you've seen, or interesting trends you see in terms of how consumers are leveraging different financial
Yeah, I mean,
services?
one thing that's happening right now, because there's been a rise in mortgage interest rates over the last 6 months, is a slowdown in
Mhm.
mortgage refinancing. Probably not, if you already have a rate of 3 or less on a 30-year, there's not really going to be incentive right now for you to refinance an existing mortgage to tap equity in your home. However, you might want to remodel the kitchen or remodel the bathroom or put in a pool. And those are major projects that might exceed what you can get from a personal loan. Personal loan is always going to win if you need a quick 10, 20,000 for something small. But if you're going
Mhm.
to need 40 to 80 to 100,000, for some major home renovation project, the home equity really now is coming back. We're seeing a rapid rise in applications. In fact, we saw a 50% rise in applications in
Really?
January over December for a home equity line of
Wow.
credit. Although, of course, our mortgage refinancing's dipped, but because there's tremendous amount of equity right now, the all across the country, home values have risen exponentially over the last few years. Byproduct of the short supply, right, in homes for sale. So people have this equity, and then they're tapping into it. So I do see that shift going on right now, and because rates are rising and because home prices are high, there's no incentive for people to sell, which kind of exacerbates the problem, right?
Yeah,
So
yeah.
they say, okay, well, instead of selling this one and buying another, I'm just going to make the one I'm in the way I want it, whether it be enlarging it or adding
Mhm.
features to it. And again, that's where the home equity line of credit comes in. And I've read a lot of reports that support that this is going to be a strong year for home equity line of credit origination.
That would be great to see, because I know historically we've seen for the last decade or more kind of slow, steady decline in that. So maybe you're right. Now we're going to see a little bit more tapping into
Now,
that.
I will tell
That
you, historically, the home equity line of credit process usually has a lot of friction to it. And this is another area where we leverage a partnership with a fintech company called First Close, right, to kind of turbo
Mhm.
boost not only our process, but how we get those applications. So that's twofold. We actually work with this company to order services like tax verifications, valuations, and so forth. And we're closing home equity lines of credit in 3 to 4 business days in a lot of cases,
Wow.
which I will tell
Three
you
to
2
four
years ago
business
it might
days.
have taken 60, right? So that's a huge difference. Um,
Yeah.
Second to that, we work with them on what's called a digital lending platform where somebody can go in and check the value of their home and
Hmm.
know how much they can borrow before they even put the application in, which upends the old model where I'm going to make an application, you're going to order an appraisal, I'm
Yeah.
going to wait 2 to 3 weeks, and then you're going to tell me how much I can borrow. They know that before they apply, and they've already told us, and we just validate the information related to the property and the borrower when we close. So that's another area we've gained a tremendous amount of efficiency in the last year.
That's a tremendous delta because when I talk to most bankers, they're talking, trying to get the process down to 30 days from 45 or 60, and maybe 2 weeks is the like long-term dream vision. And to have that in 3 or 4 days is really stunningly impressive. And to our earlier discussion, I imagine results in much both happier consumers, but a much higher conversion rate from someone who's interested in the product to someone who actually borrows from you.
Yeah, it's been an incredible lift. And so as word of mouth has spread, I think we're getting more applications just because of our process. It's not always about the price. It's about the speed as well.
Yeah, the speed is, we have certainly found that borrowers are price sensitive, but maybe equally friction sensitive as they are price sensitive. And so they will walk away for both money and pain. And sometimes I think we'll walk away from a better deal just to avoid the painful process that may exist in certain places. So you can definitely win on both. And if you can combine the two, that's a really killer combination.
Yeah.
Well, David, I got the same three questions I ask everybody at the end of the podcast. So I'm gonna throw them at you now because I think we're running out about to time. So here they are for you. Number one, what's the best piece of career advice you've ever gotten?
Yeah, listen to the people in the trenches. So anytime I've taken over a department, the first thing I do is side by sides and one-on-one interviews with people. Tell me what works, what doesn't work, what do you think we could do differently? What do you like? What do you don't like? And that's where my greatest learnings come from. And I think that's where your greatest opportunity to make some small changes very quickly come from.
Interesting. Listen to the people in the trenches. I've gotten a lot of good advice here, but that's the first time I've heard that particular piece. So I like it. What's the best piece of advice you've gotten around consumer banking or consumer lending?
Really put a focus on the employee and customer experience, right? And then develop your processes around that. I've worked a lot of organizations where they say, well, this is our process, so we have to make sure we tell our customers what our process is, whether they like it or not. Well, that doesn't always work out so well. So I call it service-oriented process as opposed to process-oriented service. So we say, what is the best way to deliver this product or service? Then we'll have processes that support that. And that ensures the least amount of friction, not only for our employees, but for the end consumer as well.
Yeah, I think that's so true. We so often get caught in. I was just doing a little post on this, and in Silicon Valley, we sometimes refer to that as like you ship your org chart, which is to say your internal team structure ends up being the way your product exposes itself to your consumers in ways that make no sense to those consumers. They go, why is this like this? And I know because there's a team over here doing this and a team over here doing this, and they didn't talk. But I think it's so true that we can get caught up in the way the process works, dictating the product versus the other way around.
Definitely.
All right, my last question: what's one bold prediction that you can give us for the future?
I think we're maybe 5 years away from a vast elimination of the human touch in processes. And I'm sorry if any of the people working on my team are hearing this, but we will. I think we need to retrain people. I'm not necessarily saying, hey, this is going to be massive layoffs, right? We need to retrain people for other roles, right? But I think the days of having individuals that have to read documents, review documents, make manual decisions, I think that's going to go by the wayside. And it's just going to make the process better for everybody.
Yeah, it's a fascinating shift, the idea that we won't have people doing processes. But I think it's a really interesting point you make that it doesn't mean we don't need people.
Right.
We still need the people. It's just a question of what they're going to be doing as opposed to the documentation and review. And I got to be honest, when I talk to people who do those jobs, they're not the most thrilling. And I think most of them are excited about the idea of moving into opportunities that are a little more creative in nature, a little more human touch in nature, a little less rote in nature than what these jobs tend to look like today.
Yeah, that's a fair point.
So it's a win for the business, but also can be a win for the employees. All right. Well, David, I appreciate your making the time today. This was a fun conversation. Thanks for joining us.
I enjoyed it. Thank you very much, Jeff. Have a great day.
You too.